Oil prices ease back as Iran indicates it is prepared to make concessions on its nuclear program. Iran and the US will hold fresh talks in Geneva this week as Tehran seeks to avert a US attack, while President Trump has assembled a vast military force in the Middle East. A senior Iranian official told Reuters Tehran would seriously consider sending half of its most highly enriched uranium abroad and diluting the rest. Well, Naveen is a senior oil analyst at Kpler. Naveen, is the market feeling a bit less nervous ahead of more talks this week?
I think there's an element of that. I think there's definitely the waxing and waning of the geopolitical risk premium as we get headlines regarding how talks are progressing, what the sort of fallout or the key headlines from these talks seem to be. But then on the other hand, as you mentioned earlier, bolstering of the military presence in and around Iran does sort of leave the door very much open for some sort of military escalation. So the market is quite tentative in terms of how it prices geopolitical risk right now. But there is an element of traders becoming slightly more sensitive into how these headlines work and maybe showing a bit more shrewd ability to either get long or take some risk off as and when we see these headlines in relation to the talks.
How much do you think geopolitics is adding on to a barrel of Brent at the moment?
Again, that's a question that's up for much of debate. Internally at Kpler, we see the risk premium now sitting around the $5 mark, maybe slightly higher. And I think this is a fairly reasonable estimate as we see the bellwether or the sort of the medium term prices sitting around $65 for Brent. And it does seem like a reasonable price level in terms of where technical or statistical resistances seem to be and how the market has been pricing, as I mentioned earlier, the various different headlines. So we see around $5 risk premium currently as the way the market has almost hedged itself for the talks versus the potential of military escalation.
What about the prospect of sanction relief for Iran coming out of these talks? How much could that unlock higher supply?
Again, that's a question that as these talks seem to be continuing and the market is maybe preparing itself for an alternative where there isn't military escalation, sanctions relief has been a topic. I would caveat this internally at Kpler as well. We do not think that sanctions relief, especially on the oil front, is something that would happen even in the fact that you might get a deal that maybe is broader or more overarching than simply the nuclear program. We don't think that there will be sanctions relief on oil, simply because it's too big of a bargaining chip and too much of a revenue source for Iran, while the US prefers to have a weaker Iran, be it with the current regime or with another regime. That being said, if we were to be in an environment where there is sanctions relief on oil, we do believe in this sort of short to medium term, within the scope of 3 months to, let's say, a year, we could see Iranian oil and condensate production climb back up towards the $4 million, the 4 million barrel mark. We're currently seeing supply out of Iran around 3.7 to 3.8 million barrels a day for crude and condensate. So essentially upwards of a 200,000 barrel per day increase in the short term. One important thing to factor is while Iran has invested, quite relatively heavily or uses quite sophisticated technology in modernizing its refinery system, it seems as though there's been less concerted investment in the upstream sector, which is why we think maybe the upside in the short term is slightly more limited.
Goldman Sachs raised its oil price forecast this morning and is now expecting Brent to average $64 a barrel this year, even without any Iran-related disruption to supply. Do you think 64 is too high?
Not at all. Essentially, it's almost quite welcoming, especially from a Kpler point of view, to see others raising their price forecast. Kpler had always been around the $64, $65 per barrel mark for 2026, even at the back end of last year. So we did see a combination of geopolitical factors along with potentially slightly better demand and slightly weaker supply than anticipated, acting as a sort of support for prices. So it's not a surprise that we've seen others raised their price forecasts as well. Again, the price now for oil contains so many different elements, with fundamentals being one part and at different times of the year being maybe a less important part than factors such as positioning, momentum trading with algorithms, and of course, geopolitics. So I think when you combine all these factors, the market does seem, in amongst all of the chaos, quite comfortable with prices around the $64, $65 mark.
That was Naveen Das of Kpler. Don't forget you can watch more videos on Reuters.com.